Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will apply a credit to an invoice that we will create within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars. We're going to be creating an invoice and applying a credit to it. Before we do that, however, we'll go through the story of what is happening here. So let's select the plus icon just to go through what is going on by looking at the types of forms we have for the customers. The typical format would be that we would have an invoice and then we would receive the payment. However, we would receive payment, so we'd have the invoice and then we'd have the received payment here. Here's the received payment. In this case, what happened is we received the payment before we had the invoice, meaning we were going to sell a guitar and we got a down payment on the guitar before we gave the guitar, and then we're going to invoice the guitar now and credit the amount that we have actually received already for it. So it's a bit reversed of the transaction. If we see it in accounts receivable, you'll remember that in a prior presentation, we recorded a received payment amount, but we recorded it before the invoice happened, and that created a negative receivable. Let's take a look at that negative receivable. I'm going to click out of here. We're going to go to the reports on the left side, and we want to look at the customer balance detail. So we're going to type in customer balance detail report. Here it is, customer balance detail. And then here's our balance detail. Now, for the Anderson guitars, we have this negative 250. If we select on that item, then we see our sales receipt. Here's the 250. That's a down payment we got. It's not applied to any invoice down here. That's the problem. So if we close this back out, I'm going to close this back out. You'll note that this is really odd. It's got a negative receivable. That shouldn't really happen because it really means we have a negative, we owe money in the receivable account. The receivable account itself represents what is owed to us. It's an asset. People owe us $965, but really they owe us $250 more than $965 because this amount really is a liability. It's not a receivable because we owe the money back or we owe the guitar. However, it works really well as a negative receivable logistically because then when we create the invoice, we can keep it in the customer balance detail and match those two things out. And that's what we're going to do now. We're going to match those two things out. We're going to create the invoice that will then match out this 250 that was prepaid for an invoice had not yet been created because we can't create the invoice until we actually deliver the guitar. So that's what we'll do now. We're going to go to the plus item up here. We're going to go to the customers once again and create an invoice. The invoice will be for Anderson guitars. I'm going to select the drop down, and we can also type in Anderson guitars to auto-populate Anderson here. And we're not going to have an email address. We do need some type of billing address so that the sales tax will calculate. We will have calculate sales tax on this particular invoice. Because this is an example problem, we're going to use just a 5% sales tax, but the online program does calculate sales tax automatically based on the location and setting up the sales tax. So we set up the sales tax and we're going to just add the address here so it will calculate our sales tax. So we're going to put the address, and so this is just an address so it will calculate the sales tax. If we tab through here, then we've got the terms, net 30. We will say that the date is going to be 02/12. Let's make this 02/18. 02/18/21, and the due date then will be 30 days later, 3/20/21. If we keep tapping through this, we're going to say that the item that we are going to be selling is going to be an ELP. So I'm going to select the drop down, and we could just type it in there as well. Either way, ELP. It's going to give us the description from the service items that we have set up already. We're going to have the quantity 1, rate, and the amount. It's going to calculate the sales tax. Remember, we're just going to use a 5% rate, so if it's not calculated yet, Once we click on the next row, it should calculate, and then we can make any adjustments we need to for a practice problem like this. But it has to calculate first before we can make any type of adjustment. We're then going to pull out the trusty calculator and say 500 times 0.05 or 5%. We're just going to use 25. So we're just going to change this to 25. It's going to give us a little sign saying, hey, that's not what we calculated. We're going to say, yeah, we'd like to keep it. It's not your fault. It's just a practice problem. And we'll type that in there for them. We now have the 500 sales amount. We've got the 25 sales tax, and that gives us the total of 525. However, we know that there was already a deposit of the 250 in this case. What we're going to do is record this and then go back into it, and it should automatically apply for us. For example, if we go up top, it says 275. That's the 500 minus the 250. Here is our payment. If this link up doesn't happen automatically, if we save this item, I'm going to go ahead and save this item and then close this item and then go back into it. One way to go back into it would be to go to the sales here on the left side and then go to invoices up top, and that will show you the invoices we have outstanding. And this is the one we're working on. It says Anderson Guitars. It's partially applied. So what happened is it automatically applied that outstanding balance because it picked up the fact that there was a negative balance due for Anderson and automatically applied it to the next invoice we made here, which would be this one. If we weren't able to see it when we generated the invoice, we may have to save it and then just go back into the invoice, and then we can print it out from that time and see the balance in there. So when we connect it, it should show that we had 525. That's the sales plus the sales tax less the 250 owing. Now they still owe us, Anderson does, the customer, 275. However, again, if that doesn't happen, try saving it and then go back into this item, and we can go back into this invoice, selecting the invoice, and it should show properly now at the 275 that is still owed to us. And we have the 500, which was the amount, and the 25 that was the sales tax, giving us the 525. And then we've got the amount paid to us, which was 250, leaving that balance due of 275. Now let's go through and think about what this invoice is going to do. It could be a little bit more complicated because remember, invoices are pretty complicated in and of themselves, and now we've got this deposit. What's all the accounts that are going to be affected here? Well, we know it's an invoice, so we know accounts receivable is going to be affected, and it's going to actually be for the entire amount, the 525. Because remember, we already had the 250 that was a credit balance there, so we need the 525 of the receivable to be posted to the receivable as a debit or increase in the receivable in order to counterbalance the fact that we had 250 negative amount before this, leaving us with an amount still owed of the 275. And then we're going to credit the sales or the revenue account, but not for 525, but for the 500. The difference, of course, 25 going to sales tax will increase the sales tax payable, a liability. Other two accounts will be inventory going down by the amount of whatever the cost was of this Epiphone not on the invoice. I believe if it was 400, we'd have to look at the items to pick that up. We will probably take a look at that as we look through the forms. And then the other side is cost of goods sold, the income account. That would also be the cost, or 400. So income went up by 500. What's going to go up? Well, the expense is going to go up, which brings net income down. The expense is going to go up by, I believe, 400, the cost, bringing the total net increase to 100 on the sale. So let's see if that's the case. We're going to go ahead and save this and then close this. And let's go to our reports and see what happens. And so when you go to the sales item here, which going back to the sales and invoices, you'll see this partially applied item here. So you can see a quick little summary of the invoices here. Let's go to the reports, left side. We're going to go to the balance sheet first. We'll say balance sheet and select the balance sheet. We'll say that the dates is going to be 02/01/21 to 02/28/21 and run that report. So here is the report. We're going to say that the receivables up top. Here is the receivables. Let's select the receivables and see what happened to the receivables. And we have this here. We got the 525. So this is what we just did now. this was the payment. So notice it's taking the whole 525, even though that's not what was owed to us at that given time, and that'll net out nicely against the 250 that was already there. So let's select this 525 and see what we have. That, of course, is our invoice. That was the total amount of the invoice plus the sales tax, sales plus sales tax, not the amount still due. So this is nice that we can print this out. We can give it to the client saying they owe us $275, and it'll record the amount of $525 netting out against the $250, leaving the amount that is still due by Anderson in the receivable account. If we scroll back up top, you'll see that we have this one payment here too, and that's nice that if we select that, it'll say, hey, we applied this out automatically to this payment. And if we select that payment, we will see the received payment that we recorded before the invoice in a prior presentation. So we actually recorded the received payment before we did the work, in this case delivering the guitar, because we got a deposit before we deliver the guitar. So we're going to close this up and let's go back to the report. So let's go back to the report summary, back to the balance sheet. If you got confused on that, we're going to reports, balance sheet, dates, the month of February 2021. And we could see then the other side of that is going to be sales, and the difference, let's look at the difference while we're on the balance sheet, which will go to the sales tax payable here. That's the 25. So if we select this icon, and this of course is because I'm in California, it says, or we put a California location on the address at least, it goes to the State Board of Equalization. Now we could have whatever location it's at, it would go to that state board or whatever the sales tax is going to be go to. It, in a more generic sense, all it is sales tax payable, but it's breaking out to who we actually pay within the financial statement. It's a bit different than the on-ground version or the desktop version if you're used to that. The formatting will generally say sales tax payable and then break it out. But in any case, if we go through here, we're going to see this, and we see Anderson here. If we add these three up, that would add up to our 25 right there, the sales tax. Let's see the other side on the profit and loss. I'm closing out of this. We're going to go to reports on the left side. We're looking for the income side, so we're looking for the profit and loss. And we're going to put the dates of 02/01/21 to 02/28/21, and we're going to run that report. So here's the report. We got the sales of product right here, the 1,000. If we select that 1,000, we will then see our 500 to Anderson. Here's the one we just were looking at. And here's the invoice number, Anderson, and the other account being, of course, accounts receivable. Selecting that item, we will then go to our invoice. Here is our invoice. We are recording here the 500. That's the sales amount. That's the amount you can think of that would be on the sticker of the guitar of the sales price that we would have there. So we're going to close that back out. And then we're going to go back to the report. While we're on the income statement, we'll take a look at the profit and loss as it's called within QuickBooks. We'll take a look at the other account on this statement, which will be the cost of goods sold. We had to give up the guitar and use that in order to consume that 500, and that will be represented by the expense of cost of goods sold. That expense 400 here's the same invoice, 400. If we click on that 400, we see an invoice with no 400 on it. How is that possible? Where did the 400 come from? It's part of this item, so the invoice is the one driving the 400 figure, but it's not seen on the invoice because, of course, we're giving this to the customer, and we don't want the cost on there. So how do we know what that is? If we wanted to find it, we would close this out, closing this back out, go into sales left side, go into the products and services, and we can go down and we can say this: we sold this ELP. And that's the one we sold. It's 500 sales price, 400, that's what we bought it for. Now we'll take a look at one more side that we haven't seen yet, and that's going to be the inventory side. So we're going to go to the reports. We're going to go back to the balance sheet. And we will change the dates once again to the month of February by saying 02/01/21 to 02/28/21. February 1st, 2021 to February 28th, 2021, and run that report. If we scroll back down, we see the inventory. Here is the inventory asset, $2,512. If we select the inventory asset and scroll down, we're looking for Anderson. There's that 400. It's decreasing by to Anderson Guitar for and invoice. If we select that 400, then we will go back to that invoice one more time. Let's take a look at one other report, and that's going to be the customer balance detail to see what this deposit payment looks like on the customer balance detail. So we're going to select the report's left side once again. We're going to type in customer balance detail. We want to see the customer balance detail. And then if we see this, it actually doesn't give quite as much detail as I would like here because it really crunches these two up. But it does give the amount, and I'm used to seeing this basically in two line items from the desktop version, where it would have the payment on a separate line item to match these two things up. But it gives it all here, everything we need. So it's got the amount for this particular invoice, and then the open balance, the $275. And if we select on this, then it will give us the invoice. And if we want to see the payment amount related to this invoice, we can select this one payment over here and get all the detail. There's the one payment made on 2/16. If we select that, then it'll take us to the received payment amount. So I'm going to close this back out. That's going to be it. So you can see that now we're back to where we want to be. Before we did this, we had this negative balance within this statement, which was really not quite right for the accounts receivable, but works from a logistical standpoint and makes it nice and easy and puts everything on the same subledger. And as long as we're completed with that and know about it before we make the financial statements, we're good. If we need to make the financial statements on an accrual basis, a generally accepted accounting basis, then we would have to make an adjusting entry if there was still an outstanding deposit that had not yet been reversed, meaning we haven't invoiced for by the cutoff date. And we'll see that when we do the adjusting journal entries. Hello, in this presentation, we will apply a credit to an invoice using QuickBooks Pro 2018. If you've been working along with us, that's great. We will continue with the Get Great Guitars problem. If not, that's okay. We will be creating an invoice and applying a credit to it for a payment that has been received in the past. If you have a backup file for this point in time, you can go to the file and open or restore. That'll bring us to the same point so we can work through the same point forward. If not, you can look at the prior presentations and see the data and work to this point. We also have the open windows open. In order to get to that, you want to go to the View tab and Open Windows List. We currently have the home page, our only open window. In order to open the home page, if it's not open as of now, you want to go to Company and Home Page. The scenario here is that we're going to create an invoice for a deposit that had been received in advance, meaning we sell guitars. We have a particular customer that wanted us to reserve a guitar, and therefore they paid us a deposit in advance. So rather than going through the normal flow that we see here within the home page, meaning make an invoice and then receive payment, we had this particular customer give us a payment, and now we're creating the invoice. That, of course, happened because we got the payment before we delivered the guitar as a form of deposit for us to hold the guitar. That's going to be common in certain types of industries. Now that we are at the point that we want to deliver the guitar, mail the guitar, and bill the client with that, with an invoice, we need to be able to apply that credit here. In order to see what is happening, we can go to the reports up top, and we're going to go to the customer and receivables and scroll down to the customer balance detail. So we can see this particular customer, see where this credit is, and then apply it to the invoice. So we're going to say customer balance detail. We're going to be working with Anderson Guitars. This is the deposit. We see this payment here. It's a negative receivable the way it has been entered within QuickBooks in a prior presentation. And that is so that we can apply it out. So this isn't exactly proper. It should be a liability, but it does help us to see what is happening within the same set of customer lists. Whereas if we put it in as a liability, we have a problem tying it out here. So this works really well within QuickBooks. It does require an adjusting entry if we have some of these outstanding deposits. So we're going to go back to the Home tab, And we're going to apply this out. So we're going to do this by selecting Create Invoice. This customer's name was Anderson. So we could select the drop down, or we could just start typing in the name, Anderson. And tabbing through this, we're going to keep the template as is. The date we're going to populate as 02/18/21, February 18th, 2021. We will be working in the future. Tabbing the way through this, the invoice should populate on its own, and we're going to tab through the rest of these items. The inventory item we are looking at will be the ELP. I'm going to type that in there. It will populate as we go. It is an inventory part. It's going to be a guitar we have. When we select a tab, it should populate. We're going to say we want a quantity 1 of those. Epiphone Les Paul. The price is the 500. The amount is the 500. We do have sales tax of the 25, bringing the total to 525. Now, we also want to apply a credit to this amount because we had received payment in advance, and therefore we're going to go to the Apply Credits. So we are in the Main tab within the invoice, and then we're going to be in the Apply Credits item. Selecting Apply Credits, it says the changes to this invoice must be recorded before continuing. We're going to say OK, yes. Then we see this one credit. There's the 250 that we need to apply out. It's already checked. That's the one we want. Therefore, we're going to select OK. Now we have the credit. So the invoice amount, 500. We've got the 25 sales tax. Total amount is the 525. Then the credit being applied of 250 received in advance means that 275 is still owed at this time. Thinking about the journal entry, we know that when we create the invoice, we're going to increase the accounts receivable, in this case, by the 525. However, we already have that 250 applied out, and therefore Anderson will only owe us the 275. The other side of it is on the sales side, the merchandise, the revenue, the income. That's going to go up by only the 500, not the 525, not the 275, but by the amount of the sales price. Then we have the difference between the sales price and the amount we're going to receive. That's going to be, or the amount that we're going to receive in total, the 525. That's going to be the $25 here. That is going to be increasing the payable, what we owe to the state for the sales tax. And then we have the other side, the amount we cannot see here, which is the cost of goods sold and the reduction of inventory. One way to look at that is we can go to the lists up top and select the item list, and we're looking for an ELP. If we double click on that item, we'll then have the information, and we can see the cost is 400. So although we cannot see the cost in the invoice, it will be recorded on a perpetual system when we record the invoice, meaning the inventory will decrease and the cost of goods sold will increase by that 400. Let's record it and see what happens. Closing this back out, closing this back out. Back to our invoice. We're going to say save and close, and then go take a look at those financial statements. Financial statements first, we're going to look at the balance sheet. We're going to go to reports. We're going to scroll down to company and financial, scrolling down to the balance sheet standard. We're going to change the date ranges up top to custom report, and we're going to change those date ranges from 01/01/212/12/31/21, and then we'll say OK. Then when we look at our range, we're going to first look at accounts receivable. So if we double click on accounts receivable, when we generated this invoice, we should see the 525 owed to us. The 250 right above it was that advance payment. The net is what's owed to us by that particular customer. This 250 was generated prior to this transaction. This is the 525 we just created. If we select that, we see the invoice that has created it. Note that we have that amount for the receivable for the full 525, the sales price plus the amount of sales tax. Closing that back out, looking at the other side, closing this back out, we're going to look at the profit and loss. If we go to the reports, company and financial, profit and loss standard. Going to change the date ranges from 01/01/21 to 12/31/21. Here is our report. If we take a look at the sales then, in the merchandise sales, double clicking on merchandise sales, we see the 500 here, not the 525, but only the sales about, not including the sales tax. Double clicking on that item, we see the 500 and the invoice that we have generated. Now we're going to look at that 25, the difference now. So if we close this back out, that will be, and close this back out, that's going to be back on the balance sheet, back to the balance sheet. Scrolling down, we want to look at the liabilities, sales tax payable. That's going to be where that payable is. Double clicking on sales tax payable, we see that 25. Double clicking on the 25, we see the 500 and the invoice here. Going to close this back out. Then we're going to look at the other side, closing this back out, which is going to include inventory. So inventory is decreasing from this invoice. Scrolling back up, that's an asset. Other current assets on the balance sheet, inventory. We're going to double click on that inventory, and we see that 400. Remember, it's not on the invoice, but it was generated from the invoice. If we double click on it, we see that invoice, although we don't see 400 anywhere on it, because this is going to be the kind of behind the scenes calculation that QuickBooks does when we generate the invoice, driven by the item that we have set up, that being the ELP, the guitar Epiphone item we had set up prior to this. We're going to close this back out and look at the one other account on the income statement, closing this back out, or the profit and loss, back to the profit and loss. We're going to go up to the cost of goods sold. So cost of goods sold, we've got this 2,750, double clicking on that. There is the 400, double clicking on that. We see the invoice once again. Closing this back out, closing this back out. Let's look for one more item. We're going to select the drop down. We're going to go to the customers and receivables, and now we're going to look at the customer balance detail. Customer balance detail. Selecting that, we'll take a look at Anderson. Here is that 525. There's the invoice. There's the prior deposit. So note how everything ties out here. We've got the invoice and then the payment. Then the invoice and the payment. In this case, we have the payment here, a payment prior to the invoice, and therefore we still have the difference of $275 due on that particular transaction. If we double click on the invoice, then once again we see that invoice that we have just generated. That amount due, $275. Both the $525 and the $250 being reflected. If we go out of here, there's the $525, there's the $250, there's the $275 still owed by Anderson.